Hi all. Well, as you can see, the S&P is still very volatile, and that leaves a lot of people with not much to do but sit on their hands. So with it being so fast, it's actually a good opportunity to do some drills. And what we're going to do, we're going to play follow the depth. And the idea is to look for an indication from the market depth of where the market's going to go, just in the very short term. Now, we all know that with the advent of all these heat map tools, there's been a lot of talk of trading against market depth. In other words, if you see big offers above you, that you should sell, and if you see big bids below you, that you should buy. So we'll look at this chart here. What that's showing us is the offers minus the bids. So if there's more bids than offers, more bids, we'll get a blue histogram here, and if there's more offers, we'll get a red histogram here. Right, now you think, well, why is that the other way? Why is that the wrong way around? Because everybody tells me if there's more bids, the market's going to go up, and if there's more offers, the market will go down. So what we're going to do is just have a look at that assumption, just watch the way these things move as the market goes up and down. Okay, so what we're going to do is we're just going to watch the depth and see if we see a big spike on one side. We're going to go with that. We can see, generally speaking, it's heavier on the offer side and the market's moving up. So we either want to try and take a bounce to the downside, or we want to have a little pullback and then try and see the depth gives a clue that it's going to go up some more. So we'll just take a look at that. We've paused a little bit. Let's see if the depth clues us in when it's going to break. Well, you can see higher on the bid side there for a second. As we start to come down, you saw it spike down. Okay, you can see the blues there as it's kind of working its way down. See if this is a little pullback. We're going to see a spike on the red side here. Something decent now, a couple of hundred at least. Now you can see really spiking on this side. I should have gone short. So remember, the idea was that it would pull back a bit and give us a chance to go long, but it seems like we got more momentum to the downside on that push down than we did on the move up. Oh, 789 hit that. Okay, so let's see the red. It's already moving up, right? We're losing the blue, but we haven't got the spike in the red yet. We really want to see a spike in the red. So we don't have that yet. There's a little spike in the red. Just get a bit more of that and we'll play it to the upside. Okay, so there you go. Let's see if we can sustain that. See if we can get that. So we need some follow through on there. Okay, you see that? And that's the drill. So the goal of the drill, it's not to make money, it's not to get frustrated, it's not to necessarily win all the time, because literally what we're looking at here would effectively be a one rule trading system. So what we're trying to do is we're trying to get an appreciation of how the market depth influences the market, or whether the market depth influences the market. And there's two ways you can kind of consider that. You could say, well, if I see high depth above me, I'll sell. And if I see big bids below me, I'll buy. You could do that, but I don't think it will work that well. You could make the assumption that I made, which is when the depth starts to spike in one direction, so when the offers become suddenly thicker, to trade in that direction. Okay, so you can do it my way or you can do it the other way. It doesn't really matter, because whichever way you do it, you're going to get the feedback about whether that was right or wrong. Then the other thing you can do, as I was doing, is just see if you can also get a feel from when a move is ending by looking at the depth. You know, when it's actually becoming a bit more evenly balanced and it might be about to turn. That's actually a more realistic use for this in a live market. But it's just one data point, right? The balance of trade, it's just one data point from many data points. We can't use all of the data points in the market as traders, and some people will get on better with some data points than others. But I think the real value of this is just getting an understanding that the market doesn't always run away from depth, and to see that and experience that yourself in a live market. Anyway, thank you, and I'll see you in the next video.